In this video, I'm going to talk about the accounting equation. The accounting equation is assets equals liabilities plus equity. And we can break down equity even further because several different things affect equity. We would take the beginning equity at the beginning of a time period, add revenues, subtract expenses. Now keep in mind that revenues minus expenses is your net income or profit or net loss, and that is considered a return on the owner's investment. And then we would also add any additional owner investments during that time period and subtract any owner draws. And that would equal the ending equity, and the ending equity would be what would go up here in this equation. So even though these are separate categories, even though revenues and expenses are separate categories, they do affect equity. And at this point, all we're doing is looking at how different transactions affect the overall equation. In a later lesson, we'll get into how they affect individual categories. Right now, this is just to get familiar with accounting and get familiar with different types of transactions and what they might look like in the different accounts. Okay, so this is the basic equation we're going to look at today. Before we look at this equation and do some examples, I just want to review real quick a few things we talked about in the first lesson. First of all, we went over these categories, and I said that I have a handout on my website with some examples. But just to review, assets are resources of a business, things they own, things that will benefit them in the future. Liabilities are debts. Equity would be the owner's claim to the assets of the business. Revenues would be money earned, and expenses are costs of operating the business. And then just a reminder that accounting is a double entry system. Every transaction affects two accounts. So what you're going to see me do is show transactions in two pieces or two parts of the equation. And it says on here that there's always at least one debit and one credit in every entry, but we're not at the point yet where we're doing debits and credits. At this point, we're just looking at how transactions affect the overall accounting equation. And then later we'll get in more detail. Okay, so if you're taking a college accounting class, you might see something like this in a textbook. It's basically just a big spreadsheet where you can plug in different transactions into this equation and show how everything balances out. So I have assets equals liabilities and equity. Under assets, there's cash, which in real life it would probably be a checking account. Accounts receivable, those would be receivables from customers. And that's considered an asset because it's going to benefit the business in the future when they collect that money. And then office equipment would be computers, fax machines, printers, things like that. That is considered an asset because it will benefit the business as they use those items to operate their business. And then office furniture, same thing. They're going to use that furniture to help operate the business. Under liabilities, I just have accounts payable, which is just money owed to someone else. And then under equity, I put the name of the owner, comma, capital. And that's just because when I was teaching for several years, a lot of textbooks would write it like that, basically just to show that that's the owner of the business and this is their capital account. And then because we're going to be putting different types of transactions, we're going to be using different types of categories in this capital column, because remember I said revenues and expenses do affect equity, but they technically are different types of categories. We have a column over here to note what type of transaction it is. Okay, so what I'm going to do is basically walk through some different transactions and show you how it would affect this equation. The first example, the first transaction is the owner invests $25,000 in the business. So that's going to affect the business cash, and that's going to affect the business capital account or owner investment account. And this is what it might look like. So the green line is going to show the actual transaction itself. And then the blue balance line is going to show the balance after that transaction. So at this point, we just have $25,000 being added to cash and $25,000 being added to the owner's capital account. And the equation does balance out. It does equal because you've got $25,000 on the asset side, 0 liabilities at this point, and $25,000 on the equity side. Both sides of the equation equal $25,000. Okay, let's go to the next example. The business purchases office equipment for $2,500. So they're adding $2,500 of office equipment to the business. And they're probably, it doesn't say they paid cash, but you would have to assume that because it doesn't give you any indication of any debt or any note payable or anything like that. So we're just going to assume that $2,500 is being subtracted from cash. So let's see what that looks like. This is what it's going to look like. Now in accounting, negative numbers a lot of times are shown in parentheses, and that's just because a lot of times you're looking at a big screen, maybe a big spreadsheet with a lot of numbers, and it's just easier when you have negatives with parentheses around them. It makes them stand out a little more. Whereas if I put just a tiny little minus sign right here, it may be a little bit easier to miss that. So it's in parentheses showing it's a negative. We're subtracting $2,500 from cash, and that's going to leave a balance of $22,500. And then over here, we're adding $2,500 of office equipment to the business. So that is being added. And that's just an ending balance of $2,500. And then over here under capital, you're just bringing down the $25,000. Nothing has changed. So if you were to look at the total accounting equation right now, you still have $25,000 on the left if you add these two numbers up. And you still have $25,000 on the right. So all you did was subtract from one asset and add to a different asset. Okay, let's look at the next example. This time, office furniture of $10,000 was purchased on account. So when you see the words on account, that's probably an accounts receivable or an accounts payable. That's just the language that can sometimes be used in textbooks, and sometimes it can be a little unclear, but that's likely what they mean when it says on account or on accounts payable or something like that. So basically you would be adding $10,000 of office furniture to the business, and then they're going to owe $10,000 to somebody, which is probably going to be put under accounts payable. So this is what it might look like. You would have $10,000 here under office furniture, and you're adding to the debt of the business. That's why it's a positive number. So you'd have $10,000 here under accounts payable. And then you would bring the cash balance down. You would bring the office equipment balance down. The office furniture balance is just $10,000. Accounts payable is $10,000, and you would bring down the $25,000 as the capital balance. So if you were to add up the equation right now, you would have $35,000 on the right side of the equation, the $10,000 plus $25,000, and then you would also have $35,000 on the right side of the equation. $22,500 plus $2,500 plus $10,000, those would add up to $35,000. Okay, let's go to the next example. The business earned $5,000 in revenue on account. So here they have on account again, and this time it's an accounts receivable. They don't owe somebody money. They must have performed some sort of service or sold some products, and they earned the revenue, but the customers haven't paid yet. So revenue, at this point, we're just putting it under the capital column. And then we're also going to show that under accounts receivable. So this is what it might look like. You would add $5,000 to accounts receivable to show that customers owe them now $5,000. And then it would also go under capital And I just made a note that this is a revenue. So we're adding to revenue of the business, and we're putting it in the capital column for now. And we're also adding 5,000 in receivables, and then bringing the balances down. So at this point, you would have 40,000 on each side of the equation if you were to do the math. Okay, let's do the next example. This time the business paid rent expense of $3,000. So this is an expense, and we're just putting expenses in this capital column. So it's going to add here, or it's going to subtract 3,000 here. Because think about it, if they have to pay an expense, that takes away from the owner's investment. That would take away from their income. And then we're also going to take away from cash. It says they paid it, so just assume they paid with the cash, which in real life it would be a checking account, but more than likely anyway. But we're just going to assume when it says paid, it means paid cash. Okay, so this is what it would look like. We would have a negative 3,000 under cash, and that would bring the cash down to 19,500. We would bring all the other balances down, and then under capital, we would show 3,000 as a negative, and we would have $27,000 left. Okay, let's look at a couple more examples. Next, we'll look at what happens if the owner withdraws $1,000, and we're just going to assume this is an owner draw for personal expenses because it doesn't tell us any other information. So that's going to affect cash and capital. So this is what it might look like. It's going to take away from cash, so it's going to be a negative, and that's going to bring the balance down to 18,500. All of the other balances remain the same, and then under capital, there's going to be a negative $1,000 to show that the owner took money out of their investment. Okay, let's do one more. The business paid $4,000 towards the debt for the furniture purchase. So that is going to take away from cash. So what they're doing is paying down this $10,000 debt. So we're going to subtract from accounts payable. And then we're also going to subtract from cash. So this is what it might look like. We have a negative 4,000 over here under cash. That brings cash down to 14,500. The rest of the balances we just brought down. And then accounts payable, we subtract $4,000 from the money owed, and it brings the debt down to $6,000. And capital remain the same. And then what you would do is look at the numbers on the right side of the equation. 6,000 plus 26,000 equals 32,000. And then you would add up these numbers on the left side. 14,500 plus 5 plus 2,500 plus 10,000. And those should equal 32,000 as well. So hopefully this kind of helped you understand the equation. And what I'm going to do is on my website, I'm going to put up this example that I had left over from teaching. It's basically just some different transactions, very similar to what I just did. Basically what you would do is just look at the transactions and show how it would affect the equation. And then I'm also going to put up the answer key on a separate document so that you can check your work and see if you did it correctly. So I hope this video was helpful, and I will see you in the next lesson.